Good afternoon, everyone. My name is Lori Richard Jandrin, and I am the volunteer president for AARP Michigan. Welcome to the Money Matters Ask the Expert virtual series. Thank you so much for being here today. This is the first event in AARP's four-part series held once every quarter on enhancing your financial literacy and the security of your savings. We're doing this series for a very good reason. We are a rapidly aging society, and far too many of us are not ready financially for retirement. Through our AARP surveys, we know a couple of things, including 20% of adults over 50 have no retirement savings, and 61% are concerned they don't have enough money to support themselves in retirement. And that's the question. And the worry that I know is on a lot of your minds. Will you outlive your money? So today, we're going to talk about building, protecting, and maintaining your money and how to stretch it across your lifetime, whether you've got a little or a lot. And best of all, we've reserved the majority of our time for you to ask questions of one of Michigan's most revered financial experts. We've had a lot of notable people on our programs, but this one is really special. I am so honored and am pleased to introduce Dewey Steffen, co-founder, CEO, and Chief Investment Officer at Great Lakes Wealth in Northville, Michigan. You know someone really knows their financial stuff when the NBC, ABC, and CBS affiliates in Detroit, the nation's third largest media market, all call on him for financial commentary. You'll also find Dewey featured in publications like Advisors Magazine and Our Detroit. Best of all, he launched a financial planning and wealth podcast that has reached more than 6 million social media viewers called What Dewey Do? I just love that. Dewey has more than 30 years of experience as a licensed investment professional and coins himself as a pro at goals-based financial planning. And he's here today to share his wisdom and expertise with all of us. Dewey, we're so privileged to have you with us here. And I know you want to jump right in and start sharing some golden insights with our audience. But before you do, I want to tell our viewers that this is an interactive event. If at any point you have something to say or want to ask a question, just put it in the chat and we'll do our best to get to everyone. And now it's my privilege to turn it over to you, Dewey.
Well, good morning, and thank you, Lori, and welcome to everyone, I guess, afternoon here on the East Coast and maybe still morning there on the West Coast. So again, thanks so much for having me. As Lori said, my name is Dewey Steffen. I am the co-founder and CEO and current Chief Investment Officer at Great Lakes Wealth here in Northville, Michigan. We are an SEC-registered investment advisory firm. We have clients in 23 states, and we're very proud of what we do. And so for today, as we kind of dive into things, investing or financial planning or retirement, I mean, these are things that, we could talk not only for minutes or hours or days, but we could probably talk for weeks, months, and years. So I'm going to do what I can in the next 10 minutes or so, just to kind of give an overview of maybe, a state of things as they stand right now. And then we'll get into maybe some of the details with some of the questions that come in. And so there will be some things that I certainly miss in these opening comments. So again, if I miss anything, you can email me after the show at info@greatlakeswealth.us, INFO, and we'll be happy to answer any specific questions that you may have, as well as you can even ask them during this broadcast after the prepared remarks. So with that, let me get into it. And we always say around here at Great Lakes Wealth, if you fail to plan, you plan to fail. And as complicated as that might seem or not seem, it really is complicated because, again, planning is details. Planning takes time. Planning is something a lot of us don't want to do, but planning absolutely matters. So again, a good plan is a great place to start. And as it relates to everyone here in AARP land, I also have some good news. Okay, we all may be 50 plus. We all may be entering, the sunset years. But what we at Great Lakes Wealth have found is a new table defining your age. And 0 to 39 years old is what we have determined as young. 40 to 79 years old, we've determined is middle age. And 80 to 119 years, we've determined that is our mature audience. And then those that are 120 plus, well, yes, now you're on the cusp of old age, okay? So we have longevity on our side, we have time on our side, and we need to make a good plan so we do not outlive our money. So with that, I'm going to kind of go through some key themes that we talk about here very briefly, and then again, we'll get into maybe the weeds with some of the comments. But we always start by asking, and again, with this audience today, there's a broad base of individuals, over the spectrum. So we always start with, are you trying to get rich or are you trying to stay rich? Do you have enough currently to live the retirement of your dreams, or are you maybe a little bit behind? Hopefully not a lot behind, but you're trying to get there. So we always ask, are you trying to get rich or are you trying to stay rich? Also, that would kind of go along with saying it a different way, which is, are you trying to grow your wealth or are you trying to protect your wealth? So however you want to think about it, those are the terms that we kind of start in. And with the comments today, I'll kind of touch on both because I certainly don't know where everyone currently stands. Okay, so when we talk about what would be the next step, you also want to determine what it is you're trying to accomplish beyond that. Are you trying to protect what you have? Are you trying to, as we said, grow what you have? Are you trying to live off of what you have, as we just said? Or also maybe you're trying to pass on what you have for the next generation and your legacy. So those are all, again, complicated topics that we could get into, and we're not going to go down the rabbit hole of a lot of them. We're not today going to talk about healthcare considerations. We're not going to talk about lifestyle plans and travel and other activities you could get into. We're not going to talk about estate planning or your legacy in any detail. And we're not going to talk about your Social Security or other income benefits that you can receive and when or why you should take them in my prepared comments. And also, again, there are tax implications when you do withdraw from any of your accounts. So we always say, talk to a professional, seek counsel to make sure that the decision being made is the best one for you in your specific situation. Okay. So with that, we're going to talk about the income side. We'll talk about the debt side, and we'll talk about, again, the investment side. But to start with, you want to know where you're at before you know where you're going. So with that, we need to start with an analysis of what we currently have in assets and an analysis of what we currently have in liabilities. And so you want to grab all your statements, your 401ks and 403bs, your IRAs, your pension statements, the Social Security benefit statements that you may have, as well as any property and deeds, life insurance, everything else that you would have, including your bank accounts, etc., to understand what you have on the asset side of the equation. But we also need to understand the liability side of the equation, and that is a fancy word for debt. So we need to understand, do we still have a mortgage? Do we have credit card debt? What other debts may we have that are out there? So that's also part of the equation. Your assets minus your liabilities equals your net worth. So that's something for you to understand of where you currently are. And that's a homework assignment. That is some of the planning. And that is some of the work that you need to put into this. After you determine your assets and your liabilities, now we need to understand, what is our cash flow? What is our income? Are we still working? Maybe we have passive income. What are the streams of our income? But also couple that with what is on the expense side. What are our expenses? Our daily living expenses, our quarterly or annually recognized expenses that are out there. So when we build a budget, we really don't need to know details on our assets and our liabilities as much as the budget is what is our monthly cash flow or income, minus our monthly expenses. And that would give us our monthly budget. And then need to replicate that for a quarterly basis, maybe semi-annually, but certainly on an annual basis. And so again, the budget is very important as a starting place. That's where we begin when we want to start the financial plan. Okay, so after we find out the budget and the details of what our monthly living expenses are, we need to understand what kind of risk profile we have. And when you're talking about your risk profile, you need to know, again, are you a risk taker or are you conservative? There's many places to help you figure that out. Some are on the internet, but be careful of what you find on the internet. But there are websites you can go to, including ours at greatlakeswealth.us. We have something at the top called Riskalyze, where you can put in some data and find out what your risk profile may be, as well as at the bottom of our website, there are other calculators. You can certainly, again, talk to a professional to find out your risk situation. Okay, so we're going to kind of get into some of the investing ideas and themes that are out there. But finally, before we do that, there are two things we need to understand. We need to understand about having an emergency fund. The number one thing we think about besides investing is the emergency fund of 3 to 6 months of living expenses. So back to the budget, times the monthly budget by 3 or by 6, and that is your 3 months or 6 months of living expenses, and put that into a emergency account at a bank, a savings account at a bank, and hopefully try high yield or money market accounts that are out there. After you have your 3 to 6 months of savings set aside for an emergency, then you want to delete any bad debt. In this day and age, interest rates have certainly risen over the last few years. We believe they will start to come down, but any debt that you have out there that is over 20%, credit cards, unsecured loans, etc., absolutely find a way to pay them off before you start trying to figure out how you'll invest. And then second, any other debt that may be between 10 and 20%, also consider paying that off before we really talk about investing. And the last comment on that, I believe it's Mark Cuban who once said, what's the easiest way to make 16.99%? It's pay off a 16.99% credit card. So think about that as we move forward. Okay, thank you. So along as we get into investing for success, after your emergency fund and after you've deleted the bad debt, let's invest for success. And before we just dive on in and do it, we need to understand, again, what are we investing in, but also how is it going to be titled? So the type of account also plays a role in what we're doing. Is your account a joint account, joint tenants' rights of survivorship, individual account, IRA, Roth IRA, 401k, 403b? All of these different account types have different rules associated with them in terms of if you can invest, how much you can invest, how it's treated tax-wise, what's the accessibility, and actually who even owns that account. So let's kind of get into it a little bit further and talk about some of the additional opportunities that you'll need to move as we go down the road. Okay, so no matter what your risk profile is, you're either a conservative, moderate, or aggressive investor. And however that plays out, and maybe you're a combination, there are investment solutions for you. And along with those solutions, we need to make sure that we really have a diversified portfolio. And diversification means not all of your eggs in one basket. There's a cliche out there that goes back many, many decades. So we want to have diversification that spreads out our risk, that also allows us to have a piece of our puzzle that may be longer term and can grow more, but also if there's bumps in the road or valleys along with the hills, it won't affect our current short-term status. Again, back to the 3 or 6 months of living expenses. So we do want to understand what type of investor we are, and then look at having a diversified portfolio. And there are several ways that you can begin building your diversified portfolio. Okay, so along with that, we could talk about a pie chart. Decades ago, there was a easy investing pie chart consisting of stocks, bonds, and cash. So you had a pie chart equal to 100% of your pie, and it was stocks, bonds, and cash. Well, now there are so many other subsets. We'll talk about just a few to kind of get the light bulb in the brain. Stocks, bonds, cash. How about real estate? How about gold and precious metals? And how about private investments? And also, how about this new category called digital assets, which also includes cryptocurrency? Okay, so we need to look at our own personal situation. Again, talk to a professional, do the work necessary to understand the different categories and understand how they may be part of your investment plan moving forward. Okay, so with everything we do, we want to start safety first and then stack on top of that more risk, which could mean more return, but making sure we have a solid foundation, very similar to if you're building a home. In this current environment, cash, if you find a high yield savings account or money markets, may yield over 4% and as much as 4.5%. So my number one investment idea for 2025 is that cash is still king. If you could take all of your investments in the perfect world and put them on a table or put them on a shelf or put them on your bed and get 4.5% interest on all of it, that's a great place to start. 5 years ago, when we were entering COVID, cash rates went down to zero as the Federal Reserve tried to help us navigate through that perilous time. And now with cash rates again over 4% and inflation is back down, according to the government, of under 3%, you have a situation where you can make money net of inflation on your cash. So that's a great starting point. Cash is king, and even bonds are back. On top of that, we then want to look at what's next. And so whether you're a growth investor or an income investor or both, we want to find investments to help you grow your money, and we want to find investments to help you income generate from your money. And they're both very different. Okay, so very common in investing for growth would be stocks, would be other investments like variable annuities. You also can look at private investments, but investing for growth means you need to give it some time. And again, as we are all a little bit older, we really might not have as much time as the younger generation. So we, again, have to recognize where we're at. But in the investment world, the S&P 500 has averaged anywhere between 8% a year and 10% a year over the last 50 to 100 years. The last 5 to 10 years, that average is really higher, maybe in the 15 to 20% range, depending on when you're looking. And we don't think that's fair to calculate your hypothetical future growth profile using that as a comparable. So if you understand that the historic rate of return would be 8 to 10% for stocks, and you can start with 4.5% in cash, that shows you there's more return, but also some more risk associated with it. In addition to the stock market at 8 to 10%, you can also look for income, and that could be income generated by real estate. There are mutual funds focused on income. There are annuities that are focused on income. There are all kinds of different ways that you can generate income on your portfolio, and we think that is absolutely important. And with the Fed now planning to reduce interest rates, typically when interest rates come down, the price of bonds goes up. And that is also why I mentioned earlier that bonds are back. We believe you can invest in a bond, also a treasury getting 4.5, or a corporate bond or a bond fund or something even making more. And if the Fed reduces rates further, there is certainly a possibility, if not a probability, your bonds will increase in price. So cash is king, bonds are back, and we do think stocks, and stocks, particularly that pay dividends, matter, will be a great place to be this year. The final two things I'll say before I open it up for some comments, as I've kind of got to the time frame that we want to leave for questions. Let's look at private investments. You have to qualify. There are certain requirements and responsibilities as being a private investor. So it's certainly not for everyone that may be on this call, but talk to your investment professional. See if investing in what is called private credit or private equity would be something that you should consider. Private investments don't have true liquidity. Private investments sometimes have elevated risks. They also have higher minimums, and you have to qualify by your investment or investor profile. So let's keep an eye on that as well. And the last category that we'll talk about would be this other category of speculative or alternative investments. And in this category, we would talk about gold and precious metals. We would also talk about this thing called digital assets, and that would be your cryptocurrency. That would be your investments in AI, cybersecurity, fintech, virtual reality, etc. So future technology, consider digital assets, and also precious metals and other investments that may not be liquid, that may not pay dividends, but certainly could be important in your portfolio. With these types of ancillary investments, the final few that I mentioned, the privates, the alternatives, as well as the ones that are not necessarily liquid or higher risk, typically we start with a much smaller piece of your pie into those. We would recommend really no more than 5% in any one of those categories. And if you think that you might be in a category or a space to do more, again, talk to your investment professional. Okay, well, with that, I think I'll kind of wrap it up. And a few things that I'll say to wrap it up would be, we want to understand that you need to build your budget. You need to come up with a plan. You need to put 3 to 6 months in a savings or emergency account, and then delete bad debt, and then look to invest for success. And I gave several options of where you can go to invest for success. And with that, I'll just say that as we're all entering our golden years, and we have done so much with what we need to do looking forward to the future, we are just getting started. So with that, I think I'll turn it back over and see if there's any questions out there or anything we can get into.
Wow. Thank you so much, Dewey. That was such great information. And I love the shout outs. I made some notes here for just myself too, so I can move forward in a good way. So now we're going to go to our audience. They have questions, and I know there's a lot of them. So don't forget to put your burning questions for Dewey into the chat. And we're going to start with a question from Carl. And his question is, Dewey, who is offering a 4% return?
Yeah, sure. Hi, Carl. Thank you for the question. There are many institutions I think you can go to, whether it's bankrate.com or other online queries for high yield savings accounts or money markets. Could be as simple as at Fidelity, other investment platforms that you can certainly find via a search. And there are absolutely multiple ones that are over 4% currently.
Excellent. Thank you for that question and for that insights that we got from Dewey. And we have another question. This question is from Brett. What are your thoughts, Dewey, about fixed index annuities?
Thank you, Brett, for that question. And a lot of the comments I'll make today as it relates to a specific product or investment, I'll really say it truly depends on your specific situation. With fixed indexed annuities in particular, they are annuities, so there is tax shelter with them, not tax-free, but tax shelter. There are requirements that you may be penalized if you pull them out or withdraw them before age 59 and a half. They do have caps as to how much you can make on your money, but they absolutely have protections. And you typically, with a fixed indexed annuity, are guaranteed at least your return of principal, if not a minimum rate of return. So depending on the situation, fixed indexed annuities are a viable option, but consult your professional for more.
Excellent. Excellent questions and great insights again. Now we go to a question from Sadie. Sadie wants to know, what traits or expertise should someone look for in their financial advisor?
Ooh, well, that's a great question too. Okay. Well, there is a place you could go on the internet to brokercheck.com. So maybe the first place you would go is brokercheck.com. That's on the FINRA, FINRA website. And that is where you can get a deep dive into any particular investment professional that's registered or an organization as well. So again, besides maybe just doing that broker check, you can also really ask them, are they a fiduciary? Do they work as an RIA? If it's an individual, they would be an IAD, but are they an RIA or a broker dealer? Beyond that, again, you might want to just ask them what types of clients they typically work with. Is that the same type of client you are? Also, what minimums do they have? What fees do they charge? Again, as we always say, an informed consumer is a great client. So again, do your work. Great question, Sadie. Thank you very much.
All right. So important to have a trusted advisor to help you navigate through these waters. Very, very true. And now we go to a question from from Ellen. Ellen was up next, and she just wants to know, this is an easy one for you, Dewey. What is the name of the podcast?
Oh, well, hey, thank you for asking so much. I'm appreciative. I have it on my mug here. It's called the What Dewey Do podcast. It's a play on my name. We also have Great Lakes Wealth on the other side of the mug. So thank you for asking. The podcast, if I could just go up on it for maybe a minute or two, it was something that came out of COVID. At Great Lakes Wealth, we're very proud of our history in the business and things that we do to partner with our community. Our mission statement at Great Lakes Wealth is to provide Wall Street solutions with Main Street values to our clients and the communities we serve. And the podcast is a way that we can give information and provide solutions to the communities we serve. Our podcast is free of charge. Our website, fantastic information, free of charge. But as it relates to the podcast, it's the What Do We Do podcast. We have new episodes twice a month on what we call What Do We Do Wednesdays. We're in the middle of our 5th season. One episode a month, we bring on who we call a leader in the community, and we ask them what they do. So one episode a month, I'll talk about what I would do in a certain situation. The one that we just dropped 2 days ago was 5 investments to consider for 2025. So that's actually a plug to kind of continue on what we talked about so far today. You can look at it on YouTube for video or listen to it on Spotify, Apple, iTunes for the audio. And as we always say in the podcast, live your best life, be radically generous, and we're just getting started.
All righty. Great. Check it out. What do we do? That's the question. And on all those platforms, we can plug in and learn everything you wanted to know, and maybe some things you didn't even know you didn't know. So excellent. Next, we have a question from Stacy. And Dewey, she's asking, do you recommend investment in silver?
Very good question there, Stacy. So silver, along with gold, we would call those the 2 premier precious metals. And gold would be the king, and maybe silver would be the queen. And it doesn't mean the queen is better or worse than the king. They just have 2 different roles, just like on a chessboard. So with silver, it really, again, depends on what you're looking at and what you're looking to accomplish. But we would really consider gold the primary hedge if you're looking at precious metals as the hard asset, and silver would really be complementary to that. But absolutely, silver could have a place in your portfolio.
Excellent. Who doesn't love silver and gold, right? Reminder again, put your burning questions in the chat, and you're going to have answered live and share all that great wisdom with everybody else who's joining us today. Next up, we have a question from May. And May asks, do you have a checklist for doing due diligence on a financial institution offering high interest savings accounts?
Well, May, aloha to you. Thank you for that question. And I don't really know if there's a specific checklist that we have. I don't even really want to answer that with any detail in case we miss something, but definitely do your due diligence. You can, again, go online, certainly the Better Business Bureau, but all of the regulatory agencies. And again, if somebody is offering something that does sound like it's too good to be true, it probably is. And so, again, I really appreciate that question, May, but there's really a lot of different ways that you would want to check to see if they're registered with the regulatory bodies, what type of, comments are there, what type, again, of other, information is out there. Not the best answer, May, I apologize, but yes, if you do your work, you'll absolutely be able to find that solution.
Awesome. And I love that she said aloha. It's probably the only state in the country without freezing cold weather. So aloha to you. So our next question comes from Layla. And Dewey, she'd like to know, what's your take on using credit cards for travel miles?
Okay, Layla, well, great question there too. And so we'll take a step back and say credit cards versus debit cards. We always say use your credit card, not your debit card. Debit cards can be broken into a lot more easily than your credit cards from, nefarious folks. So if they have your debit card, it's also much harder to get recourse from the institution when you use your debit card, and it's violated. So credit card over debit card would be our first comment there. And then again, if you're in a situation where you will pay your credit card off on time or early, then using a credit card is a fantastic tool to use someone else's money to get where you need to be, but as long as you pay them back. So whether you're getting travel miles, you're getting cash back at a retailer, whatever the benefits are that come with the credit card, that's absolutely a viable option. But you need to absolutely not just pay the minimum back. You need to pay the entire balance back in full, on time, or early. The other comment I'll make, Layla, is a lot of credit cards these days do have fees. They have annual fees associated with them. So please be very careful on that and understand exactly how that fits into your specific situation.
Excellent. Great question, though. With so many credit cards out there in the market offering so many in rewards, it's very insightful, especially as we're planning travel in the next year. Thank you, Dewey, for that response. Next, we have from Sharon. And Sharon asked, should we trust online banks?
Okay, Sharon. Well, there's a broad-based answer, broad-based question. So I'll try to give a non-broad-based answer. Again, I think you can certainly trust them if they are truly banks, truly validated, and actually, relevant and determined to be so. You will typically get higher rates and better access from these non-physical banks. They can save costs. Newer banks have a smaller footprint physically, and that allows them to have less expenses, etc. So the online banking world is absolutely relevant, is absolutely a place to begin in this digital age, but certainly you need to do your homework and recognize which bank you're working with. If they have FDIC insurance, that's a solid sign. And whether that's JP Morgan Chase or Wells Fargo or whoever else versus an online bank you never heard of, if they have FDIC insurance and you keep your money within the FDIC rules, you will be insured either way.
Excellent. And the common theme I'm picking up, Dewey, due diligence, do your homework. Be very, very careful because you're dealing with your savings, your life. So very great advice in many regards, but especially when it comes to financial matters.
Lori, real quick, I'll interrupt and just say also, I'm 53 years young, okay? And actually, I guess middle-aged. I'm 53 years old, middle-aged. But along these lines, a lot of the questions besides what you've kind of mentioned would be, again, is it safe, but is it online versus not online? Where's the online? Can I go online? So again, I think our audience probably, again, is a little hesitant to do online things. And we certainly understand that that's nothing really new. So be careful. If you're not in your comfort zone, don't go to your get out of your comfort zone. Stay there. So talk to, family members. Certainly, again, talk to professionals. If you happen to get accounts established wherever it may be, a lot of times every single transaction can be printed on paper. And around here, we'll have clients that say, hey, I feel so bad for our postman because everything we do through Great Lakes Wealth, we have, printed off and put into the mailbox. We are now definitely into a world where a lot of those things are stored online, and you really don't need to have a paper copy of everything all the time. It's actually less secure a lot of ways, and we can talk about check writing and forging of checks versus digital and transactions in that space. So again, be careful. Yes, Lori, do your homework. And if you're not comfortable, you don't have to do something that you're not comfortable with.
Absolutely. Careful, careful, careful. Okay, we have questions coming in rapidly, Dewey. So let's get right to them. Suzanne asks, please help me understand cryptocurrency in very simple terms, if that's possible.
Okay, I will, Suzanne. I'm going to do my best. First of all, we have, I think, 2 educational podcast episodes on cryptocurrency. One was back to either season 1 or season 2 of the podcast, one after that. So we kind of walk through the origin and kind of the simple explanation of cryptocurrency. What I'll try to do here, and it's not actually, on point 100%. So for all the crypto experts out there, please don't send me the hate mail. I'm going to try to do this for our audience that really doesn't understand it. Okay, if you think about cryptocurrency, in this case, we'll say Bitcoin, but there is another coin called Dogecoin, or there's another coin called Ethereum. Think of them as all, for this conversation, different currencies from different countries. You have the peso, you have the Canadian dollar, you have the the real in Brazil and other places. So think about currency. It's just a different type of currency than you would have as your US dollar. Start with that. And then think about, if you're familiar with Zelle or Venmo or electronic payments through PayPal, think about it in that regard, that if you want to take your dollar and someone wants you to Zelle them, you have to take your dollar, put it into Zelle, which may be through the bank, and then it gets Zelle to the other person's account. Or if it's Venmo, you have to move the money to Venmo, and then it goes to the person. Apple Pay is a simple one, same idea. So think about cryptocurrency in this real quick conversation, Suzanne, that you're just taking your dollars, putting them into another vehicle to pay it in a different currency similar to a different country. Now, it's not a country, and again, there's different details, 100%. But hopefully that helps a little bit about it, and certainly check for more. Do your research, and hope that helps a little.
And check out that podcast. I'm sure there's a wealth of information, and a lot of people are scratching their head, and there's some people very much into it.
Yeah, Lori, real quick on that, I'll say a few things. We've been blessed to have folks on the podcast like Kevin O'Leary from Shark Tank. We've had on Austin Hatch, who has an amazing story, surviving not 1, but 2 plane crashes as a young student athlete that ended up going to the University of Michigan to play basketball in spite of these 2 tragic plane crashes that he survived. But in addition to those, we also, again, did our 2 episodes on crypto investing, but we also went to New York and interviewed Jan Van Eck, the CEO of Van Eck Investments, and then another interview with their chief cryptocurrency investment officer. And so that's where you can truly just get into it, through our channel. But absolutely, there's a lot of information on the internet, but talk to a professional as well.
Again, talk to that professional. All right. Next up from A, just A, the letter A. A-OK. Is it okay to pay your credit card very early before the due date? And how will that impact your credit score?
All right, A. Well, A probably stands for awesome. So A, great question, and I'm not really sure how it affects your credit score. I'm not a specialist on credit scores and all of that, but I will tell you that it does not hurt to pay your credit card early. So I would absolutely pay it before the due date, on the due date at the latest, before the due date for sure. If you have some questions and if there are anything called prepayment penalties, that would be maybe on a secured card or on a different type of debt vehicle. There might be a prepayment penalty on your mortgage, on other debts that you have, typically not on a credit card. But again, do your homework, understand your specific situation. But typically, unless there's a prepayment penalty, you should be fine. And it's a good thing to do.
Good. Pay early. Right. Good. Great information. Couple of last questions with our time that we have left from Linda. Linda wants to know, at what age do you need to start to withdraw from your 403B investments?
Okay, well, hi, Linda. Thank you for the question. And again, whether it's a 401k or 403b, and I'll let you all figure out the difference between those two, but a 403b, you can start taking out your withdrawals without a penalty at 59 and a half. There are some other rules, whether you're still working or not. So really, I guess the correct answer from me would be to talk to your current employer or whoever is the custodian or the sponsor on your 403b to get your specific situation figured out. But typically over age 59 and a half, then you can make those withdrawals without any additional penalties. There are situations you can get access to your 403b or 401k earlier than 59 and a half, but let's send you back to your plan sponsor to get the details for your plan.
Great. And I'm sitting at 58 and a half. So that last year, I'm going to be thinking about these words then.
It also determines if it's a Roth 403b or a traditional 403b. So there are some now Roth investments for us folks that have a retirement plan through our employer. So check on that as well. And good stuff.
Good stuff. All right. Thank you, Dewey. From Victoria. Victoria asks, I'm at retirement age. And I'm wondering how long it takes to get good returns on an S&P 500 fund.
Well, it all depends, I guess. And really, again, a good question. I understand it. And so we always say, is it timing or is it time in? Traditional investing is all about time in. You need to compound. It takes time to take the small acorn and have it grow to the big oak tree. So as it relates to the S&P 500, if you had invested in it January of 2024, you would have made 25% on your money by the end of the year 2024. What the future holds, we have no idea. Past results are not indicative of future performance. However, we can go back and look over the last 50 to 100 years and really try to figure out. But for this conversation, we would say you really need to give those S&P investments a minimum of 5 years to maybe as much as 8 years to have what we call a full cycle of investing. That's a business cycle. That's an economic cycle. That's a stock market cycle. So we may be in the golden age and we may have another 25% year this year, but we also could have a negative year. It wasn't too long ago in 2022 that the S&P, I think, was down 15% or more. So again, please talk to a professional and recognize what it is you're trying to accomplish.
Excellent questions. All of these. I mean, this time has just gone by so quickly with all this great information. Dewey, will you please share again your email address and website and again, the podcast?
Yeah, absolutely. And thank you again for having me on. But greatlakeswealth.us is the website. And you can email us at info@greatlakeswealth.us. greatlakeswealth.us, or go to the website and there's all kinds of places to type in any messages or questions, or just doodle around and see what you come up with on your own. We just want to be part of the community. And as it relates to the podcast, that's whatdowedopodcast.com. If you want to check it out with an URL, we do have a merch store. We also have a quick link to all of our past episodes. But whatdowedopodcast.com is the URL for the podcast. But YouTube, certainly for both. Great Lakes Wealth has a YouTube channel and podcast also on YouTube. We also are very proud of our presence on Facebook, LinkedIn, Instagram, and even for these young kids, this thing called TikTok. So again, we're out there. We're very proud to be a part of today's show. We're also very proud to be a part of our community. And as we always say, live your best life, be radically generous, and we're just getting started.
Oh, love it. Love it. Thank you. I can't thank you enough. Please join me in thanking Dewey Steffen for joining us today, sharing his all his knowledge, how we can get in touch with him and keep that conversation and that knowledge growing. And as mentioned earlier, this is a series that's running quarterly, with the next one scheduled for April 18th on how to outsmart scammers who are after your money. So you'll definitely want to chime in on April 18th to find out how you can be smarter than those scammers out there. On July 18th, we'll be talking about planning your money's afterlife, from charitable donations to inheritance. So July 18th is our next one in the series. And then on October 17th, we'll be talking about planning your money's afterlife. Nope, that was sorry, my mistake. July 18th, October 17th in the fall, we'll be joined by someone with the Social Security Administration on how to get the most out of Social Security that you earn, that you've paid into. And they're all free virtual events where you get to ask experts like Dewey your burning questions. The link to register is in the chat, or you can use the QR code on the screen. Thank you all so much for coming. Dewey, again, thank you. Stay warm, stay safe, keep your money safe, and we'll be sure to have a wonderful retirement with those thoughts in mind.